Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
Imagine this for a second. It's a complete corporate nightmare, and it's playing out in real time. Your company, it just made this huge monumental acquisition. You bought a buzzy, fast-growing tech brand for, say, $5 billion.
Right. The headlines are great.
Everyone's celebrating, the stock price gets a nice little bump, everything seems, golden. But then, just 2 years later, maybe even less, the CFO has to stand up and announce a mandated $2.5 billion Goodwill impairment charge. The value, the very premium you paid for, it's just gone.
And that announcement is immediately followed by a 20% drop in your stock price. Instantly. That sound you hear, that's investor trust just evaporating, even though, and this is the crazy part, no actual cash left the building that day.
That is the strange, almost counterintuitive power of corporate goodwill. It's arguably the most important and yet most invisible asset on a modern balance sheet. It's the engine of ambition in M&A, but it is also the biggest source of, financial danger. So our mission in this deep dive is to unpack this whole financial enigma. We're going to break down what goodwill is, why companies willingly pay billions for it.
Billions they don't have to.
Exactly. And then how it's tracked, how it's monitored, and what those sudden catastrophic write-downs really tell us about strategy and about failure.
Well, and you have to understand goodwill. If you want to understand M&A and valuation today, it's that central. At its core, it's an intangible asset, and it's one that only ever appears when one company buys another one. It happens when the buyer pays a premium. So they're spending significantly more than the fair market value of all the identifiable net assets they're actually getting.
Okay, so let me see if I've got this right. I buy a company, and, after you tally up all their hard
Old
assets,
school stuff, yeah.
right, the inventory, the buildings, their IP, and then you subtract all their debt. And let's say what's left is worth, $1 billion.
Clean billion, yeah.
But I turn around and I pay $1.5 billion for the whole thing. That extra $500 million, that's the goodwill. That just appears on my balance sheet.
That is the precise formula. Goodwill equals purchase price minus the fair value of the net assets you acquired. The math is clean, sure, but the big question is why? Why would you, as an investor, be okay with management just handing over an extra $500 million for something so abstract?
And that's where the real analysis starts, right? Because in a traditional industry, if you pay a 50% premium on hard assets, people would say you're being financially reckless. But in the modern economy, companies aren't just buying buildings or inventory anymore.
No, not at all.
They are buying a strategic advantage that just doesn't fit neatly onto a physical balance sheet.
Exactly. They are buying the key to their strategic future. And goodwill is just the necessary accounting placeholder for all those critical but sort of non-verifiable things that justify paying that premium.
And when you actually look at what that premium covers, it's a list of incredibly powerful yet kind of ephemeral things. We're talking about brand equity, the sheer power of a name like Disney or Coca-Cola.
Sure.
It includes established customer relationships, which can guarantee future revenue streams, and also like specialized workforce talent.
And you have to factor in technology reputation. Is it market dominance in a certain niche? Is it the network effects that make the company you bought a mandatory piece of the whole ecosystem? And maybe most importantly, you are paying for expected future synergies.
The promise.
The promise. The promise that putting these two businesses together will unlock efficiencies or growth that neither one could get on its own.
So goodwill is basically management's quantified, documented promise that their big strategic vision for the merger is actually going to pay off. But if it's just a placeholder for optimism, how do auditors and regulators make sure companies aren't just inflating the price to look good?
That's where a really rigid accounting process called purchase price allocation, or PPA, comes in. When a deal closes, the buyer has to systematically identify and measure every single asset and liability, from inventory and patents down to debt, at their fair market value.
Right.
Only after every single identifiable item has been valued, only then is the remainder, the leftover bit, recorded as goodwill.
So you establish the concrete value first, and everything else is the strategic bet.
That's it. And if you look at modern deals, especially in tech or digital media or pharma, That strategic bet is enormous.
Hmm.
We're regularly seeing deals where Goodwill is 40, 60, sometimes even 80% of the entire purchase price. Yeah. When a Microsoft buys a gaming studio or a consumer brand buys some hot e-commerce platform, they are mostly paying for those intangible network effects and talent. They're paying for goodwill.
The scale of that is just staggering. It tells you the modern economy is built on strategic promises, not just on physical assets. But here's the detail, the accounting rule that makes this whole thing so volatile. Goodwill is not amortized.
Hooray.
You don't just slowly write it off over 10 years like a factory.
No, you don't. It just sits there on the balance sheet indefinitely like a fixed asset until it fails. Instead of that slow, predictable amortization, accounting standards say it has to be monitored. It has to be tested for impairment. And this test has to happen at least once a year, but, and this is the critical part, it has to be triggered immediately if certain strategic red flags start waving.
And these triggering events, these are exactly what analysts and investors need to watch for because they're a signal.
A huge signal.
A signal that management is basically admitting that their original deal thesis might be failing. And these aren't subtle signs. We're talking about, persistent declining revenues, shrinking margins, a big market downturn in their sector.
Or even internal stuff, right? Like major leadership changes, or if the integration of the two companies is just a complete mess.
Loss of a key customer, even.
Any of those.
Yeah.
If one of those triggers fires, the company has to do a formal impairment test right away. They compare the current fair value of the business they bought to what it's carried at on the books, including that goodwill. And if the fair value has dropped below that carrying value, the impairment is mandatory. The resulting charge, which is often billions of dollars, flows directly through the income statement.
And it is a devastating hit to earnings. But this is where we have to pause and really stress the distinction. This is a non-cash charge. No money is actually leaving the vault. So if the cash stays put, why is the market reaction always so violent?
Because while the cash isn't moving, credibility is. It's being destroyed. The charge fundamentally rewrites your reported earnings, which hits all your key ratios and how investors see you. But more importantly, it's a signal that the management team that did the deal either drastically overpaid or they totally failed to execute the integration plan they promised everyone.
It's an official admission of a strategic failure.
Yes, and that is what destroys confidence and leads directly to the stock getting hammered. The value is strategically and, emotionally, it's gone.
Let's look at how this plays out in the real world. I mean, using the specific painful dollar amounts from recent history, these case studies really show how this intangible value can get destroyed.
Let's start with Kraft Heinz. Their infamous 2019 impairment was, $15.4 billion?
An incredible number.
A huge number, mostly tied to the Kraft and Oscar Mayer brands.
Yeah.
And the core reason for the collapse wasn't a market crash or anything like that. It was a self-inflicted strategic wound.
You're talking about the failed synergy plan, right? The one that was all about aggressive cost-cutting.
Precisely. The whole deal thesis was, let's maximize short-term savings. But by slashing the marketing budgets, by cutting R&D, by gutting brand support to hit those savings targets, they ended up destroying the very intangible asset they paid a premium for in the first place.
The brand equity.
They cannibalized their own goodwill. They chose tangible cost savings over the long-term intangible value.
That's a perfect example of strategic dissonance.
Okay,
then you have the colossal failure at General Electric. They booked over $22 billion in impairments.
$22 billion tied to their power division and the Alstom acquisition. In GE's case, it was all about forecasting. They paid a massive premium because they expected demand in the gas turbine market to stay high. When that market just dried up much faster than anyone anticipated, the future cash flows that justified the goodwill, they never showed up.
They couldn't justify the value on the books anymore.
So the $22 billion bet just collapsed.
And for a cautionary tale, in due diligence, you can't get much better than the HP and Autonomy deal.
Oh, that's the textbook case.
HP buys Autonomy for $11 billion and then takes an $8.8 billion write-down not long after. The goodwill was supposedly based on alleged accounting irregularities and just totally unrealistic growth assumptions.
And a more recent one that shows how fast the world can change is AT&T and DirecTV. AT&T took a cumulative $15.5 billion write-down because their whole thesis, the idea that combining media and distribution would create this content powerhouse.
It just unraveled.
It unraveled so much faster than they expected because cord cutting just accelerated like crazy. The market shift made their strategic premium basically worthless almost overnight.
It sounds incredibly risky, but let's flip the script for a second, because goodwill isn't just another word for failure. When the strategic bet pays off, the results can be explosive. You have the case of Facebook, now Meta, buying Instagram back in 2012.
A classic. Meta paid $1 billion. The fair value of Instagram's actual assets at the time was, well, it was negligible. So virtually the entire $1 billion purchase price was recorded as goodwill.
Yeah.
It's a high-stakes bet on brand, on the user base, and on network effects.
And that bet was just genius. The key insight wasn't just, let's buy a photo app. It was recognizing that its goodwill, the network effect, the strategic moat it created, was exponential.
Totally.
Instagram today generates tens of billions of dollars in revenue. That goodwill investment delivered this incredible, sustainable value that you could never have just recorded as a simple asset on a spreadsheet.
And the same idea, really, applies to Amazon and Whole Foods.
Yeah.
Amazon paid a huge premium, which created a large goodwill balance, because that deal didn't just give them grocery stores. It gave them an instant physical retail infrastructure. It massively accelerated their logistics footprint and their grocery delivery strategy.
So the premium, the goodwill, it basically bought them time.
It accelerated their strategic ambitions by maybe 5 years, and that more than justified the initial bet on synergy.
These success stories really underline that core theme we're talking about. Goodwill is strategy, just quantified. When a high price is paid, management is making a very visible statement about what they expect for the future.
And that is the absolute core takeaway for you as a listener. Goodwill reflects the premium paid for future benefits. If those benefits don't materialize or the synergies are just badly executed, the goodwill collapses. It signals a profound failure in strategic execution or, market forecasting.
Which brings us back to why an impairment is so often a lagging indicator. By the time a company records that multi-billion-dollar charge, the underlying business has probably been suffering for a while.
For a long time.
The impairment is just the officially mandated confirmation that the strategic problem is now financially undeniable.
And this is why smart investors, smart finance teams, they focus less on the absolute dollar amount of goodwill and more on the ratio, a high goodwill to equity ratio. That's a huge strategic warning sign.
A high goodwill to equity ratio isn't just some accounting quirk, is it? It's a strategic profile. It tells you the company is heavily reliant on future promises, on intangible assumptions, not on existing proven stability.
Right.
It forces you as an investor to look past the balance sheet and start auditing the quality of the management team itself.
It forces you to ask the hard questions. Did they overpay? Are the promised synergies actually realistic, or is it just wishful thinking? Is the integration plan between the two companies actually working? Those are the questions the goodwill ratio asks on your behalf.
And finally, to circle all the way back to the impact of the write-down. While the impairment doesn't affect cash, it fundamentally shreds investor trust. When management has to write down goodwill, they are signaling to the market that they completely misjudged the core strategic reason for the deal in the first place.
And the credibility they lose is often far more damaging than the accounting loss.
So this has been a deep dive into what might be the most volatile asset in corporate finance.
Goodwill is not just another line item on the balance sheet. It is a financial mirror. It reflects the discipline, the valuation skill, and the strategic quality of a company's M&A activity. Understanding it is essential because it always tells a story about strategy, not just math.
And as you think about this journey through billion-dollar bets and these vanishing assets, consider this one last provocative thought. Since a major impairment doesn't involve cash leaving the company, but instead reflects a failure to meet projected future value, what does a multi-billion-dollar write-down signal most strongly?
Is it just a failure of strategic execution? Or does it maybe hint at a fundamental accelerating shift in how the market values these intangibles? A shift we haven't quite grasped yet. It leaves you to ponder how much of the premium paid in any major acquisition today is based on verifiable assets versus just pure faith in a synergy that may never ever materialize.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.